All right, hi, this is James Eng with Full Capital, and I'm here with jp.Conklin. I guess the president head of Pensford. Uh, let's get it going. So most people know who you are, but maybe give just a brief background, sort of how you got to where you are today, and then what I thought we do is spend maybe 15, 20 minutes talking about some themes that I saw. I got like 85 questions from people um, on floating, fixed, and all different variations. So we'll get into those. But maybe start off with sort of your background, and then I'll give you some questions to start off.
Yeah, absolutely. And thank you for having me. Before I launch in, can you hear me okay?
You're good.
All right, sounds good. So I own Pensford Financial. I started it about 11 years ago. And prior to that, I worked at First Union and Wachovia and Wells Fargo, selling interest rate derivatives to commercial real estate firms. I left in April of 2009, right after the financial crisis, to start Pensford because I realized our borrowers, no matter how sophisticated they were, didn't have a full appreciation of how derivatives worked and how hedging worked. And we were incentivized at the bank to sell a product. And I thought there has to be a market to switch sides of the table and just come over and represent the borrowers and make sure that they have an independent, objective point of view. And that's really what led to me launching Pensford about 11 years ago. So fast forward 11 years, we've ended up building a lot of fantastic relationships with guys like you. And, our ultimate goal is just to become a resource for interest rate questions. We're kind of a one-trick pony. We don't do a lot of things. We just do one thing, and that's interest rates.
All right. Well, we've got a lot of interest rate questions here. So
Good.
I wanted to start off with some themes, and this is going to hit a lot of questions, and then we'll get into the detailed questions. So interest rate forecast, next 10 years. It's a pretty
Is that
easy
all,
question.
huh? Yeah,
Pretty
that's
easy
it.
question.
Piece of cake. Oh,
And
fantastic.
then maybe talk about the relationship between LIBOR, SOFR, 10-year treasury, because that seems to drive a lot of different metrics. And then let's talk about negative interest rates. So maybe start with just that first interest rate forecast. How about that?
Okay. Well, thanks for the layup just right out of the gate.
Right out of the gate, yeah.
I'm glad that you differentiated between the floating and the fixed, because a lot of times I'll be asked what's going to happen with interest rates, and I have to immediately respond with which ones are you talking about, floating or fixed? So let's talk about LIBOR and SOFR, which generally are just fully controlled by the Fed. We've had a couple detachments in history, very brief, and in general, the Fed controls those with a lot of effectiveness. The Fed has said that they are going to keep interest rates on hold for at least 3 years. History would tell us it will be longer than 3 years. So my suspicion is that we are going to see a cycle that's not that dissimilar from what we saw after the financial crisis, where interest rates are probably at zero for at least 5 years and might be 7 to 10 years if we don't, establish a real recovery. I think that over the next 3 years is as close to 100% confidence as you're ever going to have in financial markets. They are not hiking interest rates for the next 3 years. And if they do, they will signal it way in advance. It will not catch people off guard. We have a Fed that is committed to transparency. And so it just seems very unlikely we'll be suddenly dealing with, Fed funds or LIBOR SOFR north of 1%. Let's switch gears to the Treasury. Totally different animal, controlled by the market. What the Fed does has some impact on the 10-year Treasury, but they can't control it nearly as effectively as they can LIBOR or SOFR. So I don't have nearly as much confidence over the next 3 years where it will go. I will just say it's unlikely to go up materially. And what I mean by that is like 3% 10-year Treasury is probably not in the cards in the next 5 years. I could see reasons why we might see it get up to 1.5% even within the next 12 months. 3% is probably just not in the cards. And we have a Fed who has also said that they are willing to use other measures such as quantitative easing or yield curve control to make sure that those long-term rates don't get out of sync with their monetary policy. They don't want 10-year Treasury at 3% right now because that will discourage borrowing for things like mortgages. So if we see it run up past the point that they're comfortable with, let me just use 1.5%, they'll intervene. and they will be able to keep a lid on interest rates. It might not be quite as effective as they can do with LIBOR and SOFR, but they will do things to make sure it doesn't run up substantially before they're ready to let it increase.
And then maybe touch on negative rates, because it just maybe it doesn't make sense in my head. Why would LIBOR or SOFR go negative, or even the 10-year treasury go negative, and how would impact borrowing on, let's say, multifamily?
So let's answer the second part of that first, which is it probably doesn't have a huge effect simply because I would expect banks, lenders to put floors of 0.
Okay.
I don't envision a scenario where banks say, you know what, yeah, we're going to pay you guys to borrow money. The banks that I know and the one I worked at, we're not in the business of doing that. So I don't think it'll have a huge effect. And I think that's part of the reason why the current Fed, and Powell in particular, has gone on record of saying we are opposed to negative interest rates. We don't think that they help that much. The reason that they would go negative, the reason that they're negative in so many other parts of the country or the world, is simply just trying to encourage inflation. We have this inflation problem since the financial crisis that we can't really create inflation, and it's really bothersome because without inflation, there's no real fear that something might cost more in the future. And if I'm not worried about prices going up in the future, why am I rushing to buy something today? If I have a TV sitting on my wall at home and I'm not worried that its replacement will be more expensive a year from now, I might just delay that purchase. That's not what the Fed wants. The Fed wants people to spend money and put money into the economy. So they want some inflation. That's why countries around the world have been fighting this for a while now, saying we need to get some sort of price pressure in order to encourage consumers to buy stuff today to keep driving the economy.
Okay, so flat relatively the next 3 years, still low probably for the next 5 to 7 years. And then the Fed controls LIBOR, SOFR, and then they have a little bit less control on 10-year treasury. And you're thinking negative interest rates won't really impact us because there's a floor on the, and Fannie already has a floor of 90 basis points on like the 10-year treasury, even though it's below that. So yeah, they're seeing that already. All right. So this is, and you've been preaching this longer than we've been preaching it, but sort of this fixed versus float loan strategy. And I mean, I've read a lot of your stuff, and pretty much you've said float is better a lot of the times, if not all the time. I guess maybe talk why that is, and when would anybody, or when should anybody take a fixed rate?
Sure. So this really came to me when I was still at Wachovia, because we were separated into 2 different teams. So I was in this commercial real estate team that was part of the middle markets group. And so all of our clients were doing swaps from floating to fixed. All of our presentations said, rates are going to the moon. You need to lock in now before rates move against you, right? Sitting right next to me was a guy who was selling to companies like IBM. IBM issues fixed rate bonds and they swap back to floating, okay? All of his pitch books said, floating always wins. You should always swap back to floating, right? So here we are doing the exact same products, totally opposite pitch books, because we're both just interested in selling a product, right? His pitch book was more compelling than mine, because what they concluded was, and we've got a white paper on our website, floating interest rates win almost 100% of the time. And if you stretch out the timeline long enough, they do win 100% of the time. You know, at the 2-year mark, it's like 80%. At the 5-year mark, it's like 95%. The 10-year mark, it's 100% of the time. There has never been a rolling 10-year period of time where you were better off with a fixed rate over a floating rate. And the reason is because the market overcharges for that certainty. It feels good to have certainty, right? It's like buying insurance. We got to pay a premium. We're losing usually when we buy this insurance. And so the reason I preach that to real estate borrowers is a lot of our real estate borrowers have a mismatch, this inherent mismatch between what they think they're going to do and what they actually end up doing. So fixed feels good. I'm going to lock in fixed, let's say for 10 years. And then they inevitably end up refinancing or selling or doing something before the 10 years runs out. That's when that prepayment penalty kicks in. And so it's not just is the floating rate better, it's then compounded by the fact that you pay this huge prepayment penalty, usually a yield maintenance or a defeasance with the fixed rate option, and it just compounds it. So like we did this portfolio optimization analysis for a client a couple months ago, pretty big multifamily borrower you guys would probably all be familiar with. You know, they probably have about 80, 85 assets. And we went back and looked and saw, we did the analysis and we realized, number one, had they been able to match up their time horizon better, and instead of doing 10 years fixed, even if they'd done like 4 years fixed or 3 years fixed, it would have helped avoid $48 million in prepayment penalties in the last 5 years, like $48 million. Compounding that, had they chosen 4 years instead of 10 years, 4-year rates were always lower than 10 years. So they would have picked up an additional 18 million in interest rate savings, right? And then lastly, we took the ones that they ended up only holding for a year or two and said, had you gone floating on just those, not all of them, just those, you would have saved another $12 million. And so you add it all up and you're like, we're leaving more than $100 million on the table simply because it feels good to have certainty for 10 years. But you know what? When you go to prepay after year 3 or 4, it doesn't feel good. Let's have a discussion around that and whether or not it makes sense to consider floating instead of fixed.
So I'm gonna try to be the bad guy here.
Yep, that's easy.
A lot of people have taken fixed because they get more, let's say, loan proceeds on the deal. And so let's just use an example. Let's say it's a $10 million deal. On fixed, I get 8 million, 80%. On float, I get 70%, so 7 million. So I got to go out and raise an additional $1 million.
Yep.
Does that ever come into your scenario? Because it is very real for guys raising equity right now.
100%. And it's an absolutely fair argument. And so it's something that we have a discussion about every time we help somebody, right? What is that cost of equity versus the cost of capital, right?
Right.
And having that dialogue and figuring out, okay, what might a prepayment penalty on this look like 3 years from now, 5 years from now? Let's quantify that number and have that discussion today instead of just assuming it's safer and we'll come back and pay this penalty down the road.
Down the road, sure.
And so like one of the very first questions I ask a borrower is, how long before you might start considering refinancing or paying off this loan, whether it's a sale or whatever? Because if it's 3 years from now, we should have a really serious discussion about floating. If it's 50-50, 5 years from now, let's run some analysis. Let's quantify that defeasance penalty. If it's 7 to 10 years, fixed starts feeling more and more like the appropriate choice. But let's at least have the discussion, quantify the numbers, and then you guys make the decisions best for your business.
Okay, I got that. Every syndicator is going to say 3 to 5 years. You know that though, right?
I know, right? And I'm like, okay, then let's at least run the numbers so that 3 years from now, if you prepay, you can't say I didn't know that there might be a penalty. I will say, in this environment, the penalty is likely to be far less than it has been in other environments. So it's incumbent upon us to factor in the current market environment and to say, you know what, with 10-year rates at 75 basis points, my penalty is probably not going to be more than rates going to 0, or at least not materially worse. That's different than rates are at 5 and they might go to 0.
So 10-year treasury, yeah. So that's the problem, is that 10-year treasury was at, let's say, 2% or 2.5% when you did your deal, and now it dropped 200 basis points. So your yield maintenance tripled or quadrupled from where it was. Okay.
Yep.
All right. So, I'll just agree. Let's go float. Now, how do I protect myself from the interest rates running away from me? Let's talk about interest rate caps, sort of term, strike prices, SOFR versus LIBOR.
Yep. All right. So you've chosen floating. If it's a Freddie deal, they're going to make you buy a cap, right? Presumably you're choosing floating with at least some likelihood of refinancing or selling at some point in the next 3 to 5 years, right? And that's part of the reason why you're choosing that. So you've already got a relatively short timeline. And if the Fed has said we're not hiking for 3 years, you basically have no risk for the next 3 years and then minimal risk years 4 and 5. Freddie's going to make you buy a cap for at least 3 years, and they will solve for the strike based on the DSCR metrics, right? So they will give you that number and you have to do that or something lower. And so pre-COVID, we were seeing a typical strike would be around 3.5%. Post-COVID, it's a much wider range, but it's not uncommon to see strikes as low as like 1.5%, all the way back up to 3%. And then, if it's a really strong deal, we've even seen 5%. And then we work with borrowers to figure out, is it worth spending extra money to buy a lower strike in that scenario?
Okay. And then so let's say a borrower assumes a loan and it's quoted over LIBOR. Do they go out and cap LIBOR right now, or do they buy a SOFR cap? How is that working?
So right now, almost all financings are still LIBOR-based except new Freddie financings.
Okay.
So if you're assuming a loan that's already on the books, it's almost definitely going to be LIBOR. You would presumably buy a LIBOR cap. If there's a transition at some point in that loan itself, you'll deal with it at that time, and LIBOR will simply be replaced by SOFR, and you'll have a cap now on SOFR, right? That's the goal with all the regulators. For the new term sheets that the agencies are issuing, Freddie in particular, they are forcing SOFR with the option to purchase LIBOR cap and escrow for a SOFR replacement at some point in the next year or so. So it's injected this additional dynamic, but I will give credit to the agencies to say, like, they are not trying to yank the rug out from under people. They're trying to work with people. They're trying to give them options, but they're also mandated by the federal government to help implement this transition. And so they're caught in a little bit between a rock and a hard place too. SOFR caps, they're more expensive. Aside from the cost, they've been very smooth. So it has not been a disruptive force yet. It just costs the borrower more money. In the grand scheme of things, it's usually not that much. And the cap, frankly, was probably more expensive 6 months ago before rates tanked anyway.
So tell me why. So, okay, someone bought a cap, let's say a year ago, and they're essentially telling me it's worthless now.
Yep.
So they bought a 3-year cap and they're telling me it's worthless right now.
Yep.
Does that, I guess, explain that? Like, explain how, because a lot of times when someone, let's say, assumes a loan, there might be some value there, but on these caps, after I buy it and I sell, let's say I get a 3-year cap and someone comes in year 2 and wants to buy my deal and they're assuming my loan, can they take over my cap or no?
Technically, yes. There's usually some hurdles there that you have to work through, but it is possible.
Okay.
The reason a cap is worthless very quickly after you buy it, especially in a falling rate environment, is that the market is giving no probability to that cap ever providing protection. If you have a strike at 3%, the market's saying that's not happening in the next 50 years. It's probably never happening again. Why would I give you any credit for that right now, right?
Okay. So you get no money.
Correct, right? But you bought an insurance contract. We didn't know which way rates were going to go. If they had gone up, you'd be getting paid on them, right?
Right.
Here's the other thing to keep in mind about caps. They are dictated by 2 things primarily. One is rate expectations, which is what you're describing, rates collapse. The other thing is term, because the longer the term, the more uncertainty we have, right? We all feel probably super confident that LIBOR is not going to jump up to 1% or 3% in the next month. We probably feel pretty confident 36 months, 10 years, I don't know, right?
Right.
Each extra month costs incrementally more. It's not linear. It goes up exponentially over time. So if you guys have ever looked at the difference between a 3-year and a 4-year and a 5-year, you start seeing it escalate pretty rapidly, right?
Right.
When you buy that 5-year, most of the value is in month 60. When a month goes by, month 60 has evaporated. And so you haven't lost 1/60th of the cost. You've lost an outsized chunk of the cost.
Okay.
Month 59 happens, month 58, month 57. All that value bleeds off while rates don't run up. And that's why we tell our borrowers, like, unless you need that protection, don't pay for it. You're overpaying for it. You're not paying for expected protection. You're paying for uncertainty premium. The trader thinks that you're buying a lottery ticket. Don't buy the lottery ticket if you don't think you're going to need it, because you're just throwing away money. buy a 3-year, sleep for the next 3 years, and then reevaluate quarterly for the next 3 years. At month 28, you're going to have a pretty good idea what's going to happen. If you need to buy a cap then, go buy it. It's probably less expensive, even in a higher rate environment, than overpaying for uncertainty premium today.
Okay. So I'm going to come back to that, but let me touch on this last theme. Impact of interest rates on cap rates. And you can be as broad or as detailed as you want to be on this piece.
Minimal. I know it sounds funny. It just seems so intuitive that there would be this high correlation, and there isn't. We've done a study, and the correlation is almost basically nothing. What we find is that when rates rise, lenders compensate by squeezing spreads, right? And the economy is doing better, so rents are up, and so it ends up passing through anyway. Conversely, rates collapse, lenders widen out spreads, and generally speaking, NOI drops. And so it ends up affecting cap rates in a different way. There's actually not that strong of a correlation between interest rates and cap rates, except what I would say is, in this environment, the Fed has set the stage for extremely low cap rates for the foreseeable future. It's tough to envision a scenario with 0% interest rates and as much liquidity and stimulus as we have, and cap rates suddenly spike over the next couple of years. I just think there's going to be too much liquidity for that to happen. Not necessarily driven by 0% interest rates alone, however.
Perfect. All right. So here's my sample deal. I did not give you this ahead of time. Well, I just got an email with it, so that's why I put it in the deck. So here's the 1-month LIBOR forward curve, I guess you would say. So this is the prediction by, I'm not sure who, you probably know, the analysts out there. And, it essentially stays flat for the next 3 years, like we talked about. So right now it's like 15 basis points, 1-month LIBOR. And then it gets to, 50 basis points in 4 years. And then it hits 1% in 7 years from now.
Yep.
And so my borrower got this spreadsheet and essentially said, all right, which strike should I take and what year? So I think per our conversation earlier, it sounded like if Freddie's requiring me to get the 3-year, I got to get at least 3 years of protection, but don't go out and pay for year 4 and year 5 is what you were saying.
Yep.
And then on the 3-year, if current rates are 15 basis points, at what number do I pay? What strike rate do I get? It looks like Freddie was requiring like a 491 strike. So my minimum expense is $26,000. But how low of a strike should I get based on this? So I did not prepare you for this, but have at it.
Yeah, these are discussions we have with borrowers all the time, so that's totally fine. So the first question is, what's the likelihood that you're still in this financing after the 3rd year, right?
Very likely.
Very likely. So
yes.
Then I would say there is some possibility that the 4-year could make sense, particularly at the higher strike. So it looks like the cap matrix doesn't go out the full to 491. But my guess is that price is still pretty manageable for year 4 and year 5.
Down here, you mean?
Yeah, exactly.
Okay.
Right? Because it's a totally different discussion if I'm holding something for 5 years, if I can buy a strike at 491 versus a strike at 1, right? Because you can see how inexpensive that is. Even if you did take it out 60 months, it's not going to be brutal.
Okay.
Then the analysis becomes, am I going to pay more if I break it into 2 pieces or if I just pay it all up front? So very likely, then I would say, how much cushion do you have? A 491 implies to me that you have quite a bit of cushion.
There's
right?
plenty of cushion. Yeah,
So
the
you're
spread
probably
on this deal is really low because then it's an assumption.
So then I know right out of the bat that you've got the ability to absorb higher interest rates, right?
Yep.
And so now it's more just about opportunistically, do you choose to hedge? I would say I would be reluctant to spend 26 grand on a 491 because it's just going to have zero value and just throwing 26 grand away.
Okay.
I start moving up and start having a discussion with them. Okay, let's talk about, let's say, sort of the difference between 2 and 1%. do you just buy 2%? You sleep at night, it costs $4,000 more, and there's some possibility that it comes into play. You're not totally throwing money away, probably, but not totally. Or do you start spending that money to say, listen, I'm going to lock this in and make sure it never gets away from me, right? My suspicion is I would end up saying, why don't you do something along the lines of the 1%, 75 basis points if it's the same price. Don't overpay.
So
I
you
wouldn't
don't,
pay.
you wouldn't go to the 48,000 at 50. You're thinking 38,000 at 75 basis points is enough of protection?
Yeah, because neither of them are going to come into play. It's a 3-year term. The probability that either of these pay any protection is almost zero because the people in charge of this number have said that they're not hiking. So your exposure is really in the very tail end of that, where maybe the Fed changes its mind. We have zero precedent for the Fed changing its mind in that scenario, right? They cut sooner than they expect. They don't hike sooner than they expect. So if you have exposure, it's going to be at the very tail end, months 33, 34, 35, 36, but you've already blown all that money anyway. Right. And so you're going to be waiting 35 months to see if this thing has any value to pay off in that last month or two. So my guess is I would end up somewhere between the 75 basis point and the 2% strike and just say, like, how much money do you want to spend? And I'd have to get some like philosophical responses from a borrower, because some are like, if I can put this to bed at 25 basis points for 74 grand, I'll do that all day long. And others are just like, 26 grand. What's the lowest strike I can get for 26 grand? I'm going to pay as little as humanly possible and just solve for the strike. So each borrower is different. My personal point would be, I'm spending as little as possible because I think all of these are throwing money away in the 3-year term. Let's dig in whether or not it makes sense to look at something like a 4 or 5 year at the higher strike just to satisfy the requirement. So I'm not potentially buying something later on and paying transaction costs twice.
Okay. Yeah, they were, and we just got this today, so we haven't decided, but sort of in that 48 to 38,000, either one is small relative, like this is a $20 million deal, right? So it's just, either one is fine, right? They built in 50,000 for this cost, so they were fine either way. So, but I do understand that, do I want to spend $10,000 when the probability seems really low just to feel better about 25 basis points? I don't know, right? Like that's, yeah.
And to me, now you're talking more about a business decision than a trading strategy, right? Trader would say, don't spend anything.
The trader would buy the 26,000 at 4% and just.
That's right.
Okay.
Like, and on our website, like we have this analysis where you can do that and see the projected payout and economic benefit. And what you would see in this one is every scenario is a waste of money. And so a trader would say, spend as little money as possible because all of them are going to result in throwing away money.
So take the 26 and move on with your life because it's the minimal. Okay.
That's right.
All right. So I thought the forward curve on LIBOR was interesting. I think you've explained it plenty of times, but when I looked at SOFR, it was a little different, and I didn't know why. So I was going to just ask you, does this make any sense, or this is forward, or is it because there's like not enough history on SOFR that this is just a guess as well?
It's just a guess. It's a worse guess than LIBOR, right? And so what I would expect is over time that they will largely track about the same. So like we have a SOFR forward curve on our website, and I would just tell people, just use LIBOR and take 15 basis points off. Like that's probably going to be about where SOFR goes. And I trust the LIBOR forward curve far more than I trust the SOFR forward curve.
Okay. All right. So I'm going to open it up here real quick and see if there's any questions from the group. If you want to put it in the chat or try to raise your hand, I can attempt to find you. So if anyone has any questions, raise your hand or put it in the chat, and we will let JP answer it. If not, I have 40 questions on these slides behind me. So.
Oh, great.
All right, guys, this is your chance. Or do you want me to just keep going? Is this good enough? I'll just keep going with these questions here. All right, let me see. All right, as you guys think of questions, let me know and we'll jump in here. I think we had a question here. Okay. Joel asks, what, if anything, can I do as a borrower to minimize my cost of debt?
So just speaking on the interest rate hedging side, again, it's going to go back to first question is always, what is the hold, right? What is the hold period? Match your debt with the anticipated hold period. That's probably the most common mistake that I see because fixed just feels safer. And to your point, maybe you get greater proceeds. That tends to burn people on the exit. On a disposition, that tends to burn people. If that makes you more comfortable, that's what you want to choose. Great. At least quantify those numbers before you choose it, right? There's probably a 25 to 35 basis point difference choosing 5 years versus 10-year fixed right now. That can add up over time. Quantify it and then make a decision about whether or not it's worth doing that. I think that's probably the biggest mistake I see is it's kind of like the way that we buy houses and our mortgages on our houses. 30-year fixed, 10-year fixed, right? It's just kind of like the stock answer instead of saying, well, yeah, but I might be moving in 3 years. Wouldn't I save more money by taking something else? And let me think about that more strategically and then make a decision.
Okay. JP, I'm going to go off script again.
Awesome.
And I put this spreadsheet together and I'm trying to, let me see if I can copy it and show it real quick. Hopefully it works. And you tell me if this is reasonable. Okay. So this is the loan of $21 million. Okay.
Yep.
And I was trying to quantify. Can you see that okay? Do I need to make it bigger? Is it all right?
Nope, it's
okay.
good.
All right. So this is a Freddie Mac loan, 3% interest rate, 3 years IO, interest rate cap is $50,000. And what I assumed was, okay, this is your prepay on the top, 1%. You've got your interest of $637,000. You got to buy a cap every 3 years. And then if rates went up 10 basis points, let's say a year, this is the additional interest that you would pay on top of the 3%. Okay.
Yep.
And so what I was trying to figure out, and then what I did was the same thing for Fannie, same thing for step down prepay. And what I was trying to figure out was, what is my total sort of interest plus prepayment cost plus any transactional costs?
Yep.
And at what point is a fixed rate better, if that makes sense?
Yeah, you're just solving for the point of indifference.
Yeah.
Yeah.
So when I did it, this is the summary on the bottom. The floating rate won the first 5 years. And in the outer years, like a 10-year fix with 7 years yield maintenance won year 6 through 10. But that was assuming interest rates kept going up.
Yep.
Which, is anyone's guess. Is there anything, when you look at this, is there anything that I'm missing or should be taking in consideration? Because I've had a lot of comments on this sheet and just wanted to see what your thoughts were.
So I think that what it's basically telling you is intuitively, it kind of makes sense that floating and fixed, you should really be indifferent at any given moment when you're choosing between the two. And so the fixed looks worse the first half and then looks better the second half, right?
Right.
Especially as the defeasance or the yield maintenance burns down.
Yes.
If you were looking at a fix, right? It starts dropping off pretty precipitously.
Yeah. So right here, the yield maintenance piece, like on a 7-year yield maintenance, it's going down about 600,000 a year.
Yep.
And so by year 7, year 8, you're only at a 1%.
Exactly.
Yeah.
Right.
Okay.
So yeah, so I think you're thinking about it right. I would say over a 10-year period of time, we're probably likely to have another downturn in interest rates, or they just never go up, right?
Okay.
And so like we would run a scenario with a borrower that says, well, I'm just going to set it at zero, right? No changes,
Okay.
and it just is going to be flat. And then how does that compare, right?
Okay.
Because it should end up being cheaper than what the fixed is. If the fixed is, I forget what interest rate you ran the fixed at, but I would
3.1.
presumably
It's only
a
10
little bit
basis
higher.
points higher. Yeah, 10 basis points higher on a yield maintenance, but then it's, 50 basis points higher on a step down.
Yep.
Yeah.
And then start thinking, well, how does that impact our business model? What's the probability that you actually have this for the full 10 years? Because when a borrower tells
0.
me, right, that's why floating is better. It's not because I actually expect that there is no scenario where floating doesn't end up costing you more during a year or two. It's that you're never in it for the full 10 years.
Right.
And you exit while the prepayment ends up being super high. So if you have a borrower who says, I lock in for 10 years and I never touch it, fixed makes all the sense in the universe to me. That's not how most borrowers behave. They think they're going to be in it for the long haul. They're out after 3 or 4 or 5 years because they can take out money, and then they've got this huge yield maintenance that eats out of the proceeds.
Right. Okay. So a couple comments that I received was, all right, is if you had to choose a number on the interest rate assumption increase, what would it be?
For a floating rate?
Yes.
I think that you've got a reasonable assumption. And in
Okay.
fact, I would say some borrowers will be more conservative than what you've built in here, but that feels reasonable. If I were to tweak it, I would probably say the first 5 years have no change. And then it starts stepping up, probably in 25 basis point increments, and it's more weighted towards the back end, in other words.
Now you're making me do hard Excel now.
Well, listen, you're going to throw a spreadsheet at me without any warning. You can play that game.
I have to come in and change my formulas here.
Yeah, exactly.
Second question that I got, people are trying to get accustomed to taking floating rate. And the other thing that I got was, all right, right now it's 50,000 for this interest rate cap. But in year 3, what if this goes to like 500,000? Then my numbers are all messed up.
Yep.
So maybe shed some light on interest rate caps and sort of where they've been historically versus where they are today.
Yeah, and that's a totally valid concern. What I would say is, again, number one, most people don't end up buying a second cap, and certainly not a third cap, right? Very rarely does that end up happening. Number two, we're in this cycle where we've been told by the people who are in charge of it, they're not hiking, right? And so that 50 grand cap, if it costs more than 50 grand 3 years from now, it's not 500 grand, it's probably 60 grand or 75 grand. It's a number that most people can tolerate, particularly if they're able to go refinance, if that's the alternative, right? And I'm just going to go get new proceeds and move on from this loan. So it ends up not being a deal killer. It's something that they pay attention to. We're not going to see a 500 grand cap on that 3 years from now. That's not happening. Okay. If you can live with that thing costing 75 grand, 100 grand, you're going to be fine.
Yeah, it doesn't material. You still win, right? You still win on the float regardless. So this is probably the biggest difference. It's just that the underwriting coming on floating rate loans is just more conservative for whatever reason. And that $1 million in proceeds is what people have to get over. And
it's all the same reasons that you're highlighting, right?
Yeah.
From an underwriting perspective, they're worried that the cap is going to cost 500 grand 3 years from now. And so they're like, let's just make this easy and just do fixed, and we'll encourage you to do fixed, and we'll give you more money because it's easy for us to underwrite and put it to bed, right?
Yeah.
Oh, by the way, we'll just get this yield maintenance calculation coming out of it on the back end too.
Right. Okay. All right. Good. At least I'm not crazy.
No, you're doing great.
I put that together because a lot of people were asking. So, all right. Let me see if there was any other questions real quick in the chat. I'm not sure where my chat went, so I can't see it right now. So let me just keep going with these questions. Let's go with the rapid fire answers as much as possible, and we'll try to knock these out in the next 15 minutes. Does that work?
All right. Yep.
Okay. All right. Gary asks, how confident are you that rates will remain low?
So floating rates like LIBOR and SOFR are extremely confident, as close to 100% as you're ever going to have in financial markets. The 10-year treasury is almost as confident, but less so. But even then, it's range bound. It's not going to 3% in the next couple of years. If it goes up, I think 1.5 is probably a reasonable ceiling that we might expect to see in the next year or so.
So will that bail out? That will help people, let's say people who are stuck in yield maintenance right now. If 10-year treasury goes to 1.5, that will help them.
It'll help them on the yield maintenance, but that'll be offset by a higher interest rate on the new financing, right?
Right.
So
no, I'm saying sellers. So there's a lot of sellers right now
yeah, absolutely.
who are stuck in yield maintenance. 10-year treasuries at 0.7.
Yep.
Yeah. Okay. What is, I think we talked about, so you're thinking conservative way to underwrite those adjustments, 5 to 10 basis points, or even 0, 0, 0, and then 25 basis points after
Correct.
that. Okay.
Yep.
Inflation projections. I guess we haven't touched on this.
Yeah, no, and this is top of mind for everybody. And I would say that the Fed would love to have an inflation problem right now. They would gladly trade out inflation for the current concern, which is deflation, or at least disinflation. So what we saw after the financial crisis is that it was such a shock. We only got to 2% inflation twice in a 10-year period of time. And so I know that there's all this talk of stimulus and, massive quantitative easing and 0% interest rates and how that has to result in inflation. And I would say it didn't before. We have a very recent track record that showed inflation is different now than it used to be. And we don't necessarily know why, but I think we just have to acknowledge that it is. And so I would say, inflation of sort of 1.5-ish% with a couple bumps up and a couple bumps down. I think the Fed is going to be dealing with sort of sub 2.5% inflation for the next decade.
So I guess maybe you can educate me on this. Obviously, rents inflated more than 2% over the last 10 years in most markets. But I guess, is that not taken into consideration in these inflation numbers that the Fed is looking at?
It is, but that's just one of a million factors that go into their basket of calculations.
Okay.
The other thing I've noticed from people, I had this from a broker in LA who emailed me and said, I think the inflation numbers are hogwash, right? They're totally bogus. Everything's up. He listed off 7 things. It's actually went and investigated the 7 things. And the only one of those 7 that was actually higher in LA over the last 10 years was housing. He thought gasoline was up. He thought all these other, they weren't. They were actually down over 10 years, except for housing, which is driven by low borrowing costs, right? Everybody in commercial real estate is benefiting way more than people in other industries because our industry is so heavily benefited by 0% interest rates that borrowers are benefiting way more than a typical person. Minimum wage person 10 years ago feels about the same today as they did 10 years ago. A commercial real estate firm feels way better today than they did 10 years ago, and it's not a coincidence.
So 10 years from now, should we look back at today and say we should buy everything?
Yeah, probably.
All right. Versus that new TV, right? So
yeah, exactly.
Raymond asks, what is the biggest factor impacting the interest rate you receive?
So that to me sounds more like a spread question that I would kick back to you, because from my perspective, I'm mostly based on the market interest rate, the underlying interest rate, and that's just going to fluctuate, and you will make a decision at closing, basically. For you, it's probably more about what's the credit quality, what do the rents look like, stuff like that.
Yeah, I would say, Raymond, the easiest answer on this one is leverage and debt service coverage. So as you go up higher in leverage, if you're 80% leverage, 125 debt service, that interest rate is going to be higher than as you go down to 75% or 65%, 135 cover. And so as you get more coverage, you're going to have a lower interest rate. So that's probably the easiest answer on that one. Different loan options for non-stabilized properties post-COVID. Do you want to take that, or you want me to just touch on that?
That's your wheelhouse. Now we're way above my pay grade.
This one is really non-stabilized properties, so that's something 90% occupied or lower. So that's really going to be a bridge loan post-COVID. Okay, maybe touch on who primarily uses floating rate loans and for what purpose.
And this is pretty straightforward. People who expect to be out of that loan within, let's say, 3 to 5 years.
Okay.
Value add shops. Somebody who wants to do a development. Like, it is always geared towards people with shorter term horizons. Very few of our borrowers have an interest rate strategy around choosing floating over fixed because floating wins 99.9% of the time. They have other business factors that are driving that decision, and it's usually about what's my disposition.
Okay. Cap rate predictions.
Low and low for foreseeable future. Yeah.
All right. Premier loan product available today.
That's your wheelhouse.
I would go back. We've touched on it. I mean, Freddie floating has probably the best loan right now. The thing you have to remember, and I showed it in an example, is you're not going to get the highest loan amount. They're more conservative on taxes. They're more conservative on just sort of what they will give you. And you have to balance that with your disposition and the prepayment that you would have if you did a fixed rate. So interest rates going negative, and is that inflationary or deflationary for real assets?
Yeah, and that's a great question. And if we knew the answer, I think it would increase the odds that we would be willing to take rates negative. So probably 4 years ago, I thought that there was a very real chance we would have negative interest rates in the United States. Actually, today, I feel less so in the near future for a couple reasons. Number one is that Powell is opposed to them. His term does not expire until February 2022. So there is some risk that we get a new Fed chair after that who says, let's take rates negative. Even if we did, the impact to us is minimal. And I suspect it's like negative 10 basis points. I mean, the most extreme example is Switzerland, negative 65-ish basis points. So we're not talking about dramatic numbers. Even if we did, I think more importantly, they haven't seen any benefit from taking the interest rates negative. It's not like the Eurozone suddenly recovered fantastically and they have 2% inflation, very stable, right? So the results are mixed. It feels like the answer should be inflationary, but people on the ground in Europe might argue, you know, something's going on and it's actually been deflationary for what we've got going on over here. So I think Powell is conflicted with this, and that's why he's not going to be excited about taking interest rates negative. They'll use other tools first before they take interest rates negative.
Maybe touch on what's the other tools.
So we've got quantitative easing, which everybody's probably familiar with now. The big new one is yield curve control, where they basically put a cap on treasury yields. So they say, we're not going to let the 10-year treasury get above 1.5%. Anytime it gets above 1.5%, we will buy so many treasuries that it pulls us back down below 1.5. Japan's been doing that for, I think, 2 or 3 years now. Just trying to anchor those rates so that the cost to borrow does not go up, and we can continue to sort of prompt the economy along. The complaint I would have about that approach is the same issue that we've had the last 10 years. It really only benefits asset owners, right? There's a reason that we've got this income inequality. It's because asset owners are benefiting from those sort of mechanisms way more than the minimum wage employee, right?
The $1,200 that went out to them, that doesn't benefit them?
That's different though. So I'm glad you brought that. That isn't monetary policy. That is fiscal policy. And that's why Powell has been saying we have to pass the baton back to Congress. The Fed never passed the baton back to Congress after the financial crisis. Congress got really comfortable with the Fed bailing them out and just being the scapegoat for all the issues. Just keep interest rates at zero for 10 years and we'll get our way out of this. And that's why we never had a real recovery. This time around, Jay Powell is speaking up more and saying, listen, we have done what we can do. We've set the stage. Rates are at zero. We've got as much liquidity as possible. We need you, Congress, to start doing things such as sending out those stimulus checks, such as, you know, reducing taxes, streamlining regulation, doing all those things to actually encourage real economic recovery, not one that's artificially based in 0% interest rates.
So I think it was the CARES Act. It was like, let's say $2 trillion that went out. And then, but the Fed's balance sheet increased like $4 trillion. Is that right? Like in March or something, or April and they did it. How did they do when they increased their balance sheet that much, were they buying treasuries? Were they buying corporate bonds? They were buying everything, it seemed like.
Yeah, so they got to the point, so two separate issues there. You've got fiscal stimulus, which then ends up running a deficit, right? That's not the same as the Fed balance sheet. The Fed balance sheet is just the Federal Reserve literally buying treasuries from the Treasury Department in order to keep a lid on interest rates. And so and provide liquidity and market stability. So their balance sheet bloated again, right? From buying first and foremost Treasury, secondly MBS, and then they announced that they would be willing to buy corporates. The announcement alone was enough to stabilize that market so that they didn't have to go buy those. So they haven't really gotten into that the way that they said that they would be willing to, because the announcement alone reassured markets and provided some stability. And corporate bond buyers said, I know I've got a buyer in the Fed if needed.
It's like when you're buying multifamily and you're like, what's the next buyer who's gonna buy this from me, right?
Exactly.
And
Yeah, exactly.
oh yeah, the Fed's gonna buy it from me, so I'm good. All right, Alan S. Rules of thumb: fixed versus floating for assets purchased in the next 12 months.
First rule of thumb is 3 years or less is almost always floating.
Okay.
The more unsure you are of when you're going to get out, the more likely you should consider doing floating. The closer you are to a 10-year hold, the more you should be considering fixed. So I tend to think of them as a spectrum. And the closer I am to the 0, the more likely I am to do floating. The closer I am to the 10, the more likely I am to do fixed.
Okay, perfect. This is like the biggest softball question I've ever seen. Is it possible to buy a cap on floating rate loans? So I'm gonna toss that over to you, JP.
Yeah, I mean that's our primary way of keeping the lights on here.
That's what we do.
Yeah. So I appreciate Marco. Yeah, that's all we do. Not all we do, but that's like what we do. We probably do 400 caps a year. And I would guess that half of those are Freddie caps. Freddie mandates cap purchases. Debt funds used to be way more active and they would require caps. And now we're seeing people saying, I just want to buy a cap on my floating Wells Fargo loan because I just want to make sure it never gets away from me for the next 5 years. So yes, you can 100% buy a cap on floating rate loans, and there's a huge market for that.
Do you expect SOFR pricing to change in the next 6 months?
Yes, but I don't know that I would say meaningfully. So there is no liquidity in SOFR. SOFR is not going well. Freddie is mandating the transition, and so people are doing it. That doesn't mean that trading desks are doing it. Trading desks are not hedging using SOFR. There is no liquidity in SOFR futures. So trading desks are still hedging it the way that they hedge prime. Prime is a made-up index, right? You can't hedge prime. So they hedge the correlation between LIBOR and prime. Same thing with SOFR. The confirm that you get with the cap confirmation that Freddie wants will say SOFR in it. The trader who sold it to you never actually hedged SOFR. They hedged the relationship between LIBOR and SOFR. And then because they're so concerned about that relationship, having no track record, they charge you a bunch extra. So what we're seeing is almost regardless of the cap size, even if it's a 10 grand cap, the SOFR cap is going to cost you at least 15 grand more. And if the cap gets big enough where it's like 100 grand, 150 grand, they're probably going to charge you 40 grand more. It's more like a flat fee that they're charging on top of it, because it's really underneath all of it. It's a LIBOR cap. And then they're charging you extra because yours says SOFR, and they're going to be on the hook if they have to pay you on that.
So that's an expensive 4-letter word.
Yeah. But here's the thing.
Yeah.
A cap today, a LIBOR cap might cost 10 to 15 grand. That same SOFR cap costs 25 to 30 grand.
Yeah.
That's probably less than where a LIBOR cap was 6 months ago before rates collapsed, right? So for most borrowers, they wrap their brains around, like, yes, it cost me an extra 15 grand. It's cheaper than it would have been 6 months ago. So
if somebody's building in their cap cost is 50, like let's say most deals that we look at on a floating rate, they're probably 15 to 25 million, 30 million maybe. Is someone using 50,000 as their SOFR cap pricing? Is that reasonable? Is that sufficient?
Yeah, that's probably a reasonable number.
All right. I think we hit that. We touched on that. I don't know if you have any comments on bridge loans. I know you mentioned that a lot. I mean, I'm seeing more Fannie Freddie business right now and not a ton of bridge loan business. Any comments on bridge loans from yourself?
I would say that they disappeared entirely. They're starting to come back. The pricing is much wider than it used to be. And that as long as the economy continues to recover, I would expect that the pricing would gradually improve over time. It's still going to be way worse than it was a year ago. So the vast majority of things that we're seeing right now are agency related.
Yep. Okay. We touched on caps. I think we hit fixed rate loans. I guess ideal loan term for a multifamily syndicator. Yeah. Any thoughts on that one?
I mean, I think that to beat a dead horse here, it's always about what's my hold period. Like,
Right.
give me that. That's what we need to. Then we'll solve for the loan that matches it. Don't let the loan drive the bus.
Okay. I think you hit on this. Selling in 2 to 4 years.
Floater.
Float. Yep.
Yep.
When will rates increase?
So short-term floating rates, not any time before people forget that this conversation ever happened. The 10-year treasury, the biggest risk right now is a stimulus package followed by the election, right? Rates popped up the last 2 days because there's an increasing likelihood of a blue wave. And if that happens and the Democrats seize all three aspects, way more likely to have some sort of fiscal package or stimulus package to get passed after the election.
All right. That is all the questions that I had for JP. I appreciate you jumping on and answering these. I'll open it up one more time before we jump off here in a couple minutes. Any questions from the group? You can raise your hand or speak up. I can try to unmute you at that point and have any questions for JP. Yep, Alan. All right, let me try to unmute you. I think that it worked. All right, go ahead, Alan.
Thanks, JP and James. Appreciate it. I think I know the answer to this, but it just struck me as, having done some Fannie loans before and, liking the option of being able to have a supplemental. It sounds like kind of in the current environment, that's not really a great option. Whether you're planning on selling it or refining it, within 5 years versus say 3 or 4 years ago.
Yeah, so most of the supplementals that we work on are Freddie, but I know that Fannie's is largely the same concept. I would say that the supplemental process, the underwriting standards have made it more challenging, but that doesn't mean that will be the same 2 or 3 years from now. So like we have a pretty large multi-borrower who supplementals are part of their business model. They're still closing on Freddie fixed to keep that option open, even if it's not going to be open the next year or two the way it has been in the past. So I still think that it's viable, even if it's less so today. It probably will be at some point in the next few years.
Fair enough. Thanks.
And Alan, just to add to that, a lot of times, let's say you take a floating rate deal. If you want to come out and do a refi, it's a 1% penalty, and a lot of times Freddie will waive that 1% if you do another Freddie.
Yep.
So it ends up, you end up just getting the same proceeds back, right? Because you're just getting a new loan.
Got it. Good stuff.
Nika, let me try to unmute you. All right.
Can you hear me?
Yeah.
Yep.
Okay. Hi. Thank you. JP, we're from a real estate investing background, so we're used to the 30-year fixed. How do we get our arms around the difference in the risk with the floating rates?
So I would say first you look at historically how have they compared, right? And so that's sort of an analysis I described where over a long enough period of time, floating is always better. And I think you start there. And then you start tackling the ones that would make the most sense, which again, short term. If it's a 3-year, let's dip our toes in the water and at least consider it. Consider what is our risk? What's the likelihood that a floating rate option is going to be materially worse than a fixed rate option? I have found that for our borrowers who have started dipping their toes in the water, especially if management is a little bit more conservative than maybe the people who are trying to make the capital market decision. They start with like the layups, the easiest ones, and they show the analysis, and the boss knows that they're going to be out of this one in 3 years. Let's start with this one, right? And then we gradually roll that out to the rest of the portfolio and start making it more of an interest rate diversification discussion every time we go into a new deal, not one is going to win versus the other. Make it more about, let's just make this part of our closing process. Let's have a discussion, which makes more sense, floating or fixed, and why. And then we found that they generally at least appreciate the analysis, and they come around over a long enough time, not try to punch them in the nose and say, you should be all floating right out of the gate starting today.
Yeah, let's refinance the whole portfolio to
Right,
floating.
100% floating.
JP said it, right? Like, take one deal at a time.
Exactly.
Thank you. Thank you very much.
Any other questions? Ashley, let me unmute you there. Yeah, good.
Hey, thanks. Yeah, as I'm formulating this question, I feel like it's an obvious answer, but for some reason it's given me, I've had to weigh it for a couple of days. So right after this is over, I've got to decide either a 3.5 for fixed for 10 years or a 3.9, other way around, 3.5 for 7 years, 3.9 for 10 years. The fees are lower with the 3.5. And so I guess it brings it down to, is there any difference between a 7 and a 10? I mean, risk-wise for me,
yeah. So the first,
for a while.
The first question is, what's the likelihood that you're going to be refinancing this after 7 years?
From at this perspective, this is an asset that we probably would intend to hold on to for a while. We've repositioned it. It performs well. It's stabilized. The asset's in great shape. So, you never know. We could sell it, I guess, if someone brings us the right number. But our intent at this point is to hold on to it.
What's the prepay, Ashley, on the two different loans?
Yeah.
Actually, there isn't any after 5 years on either of them. So
then what you got to do is you take the 40 basis points difference and you solve for your point of indifference 7 years from now, which, sort of back of the envelope, let's say is sort of like 120 basis points over the last 3 years. And then you would say, on that 7 year, I'm going to refinance into a new 10 year. So it's really just 12 basis points per year, right? What is the likelihood that I'm paying, roughly speaking, more than 3.62 7 years from now? Do I want to take that risk? My guess is if we ran the analysis, the conclusion that you guys would have is, maybe we just take the 3.9 for 10 years, except that you said that the fees were lower on the 3.5, right? And that ends up being a totally different calculation because one is paid out over time and one is paid out at closing, different math.
Right. Okay.
Why is the fees different, Ashley, on the 7 and 10?
Well, it's actually a refinance. So it would be keeping it at the current lender. The fees are a lot less than if we took it to a different lender.
Yeah.
So that's really the difference.
That makes a difference, right? To me, that's more of a business decision than like an interest rate analysis decision.
Okay.
And just for my curiosity, is it Freddie SBL or no?
No, this is
just a recourse bank loan.
Small potatoes for this crew, but it'll be a $2.1 million loan amount. So
just with a recourse bank loan?
Say again?
Is it just a recourse bank loan then?
Yes.
Okay, gotcha. Okay, all right. That's fair. The only thing that I would throw in there is you should probably have it quoted Freddie SBL because your rate's probably lower and it's non-recourse on the refi. So just maybe check that.
Will Freddie SBL do student? It's a high concentration of students.
There you go. They will not.
There you
got me.
All right. I just want to make sure I didn't miss anything.
All right. I'm trying to think. Any other questions out there for JP? Well, JP, I appreciate it. We'll see you in 2 weeks at the big show.
Looking forward to it.
you are more than welcome to stay on. I'm just going to do just sort of a quick, let everybody introduce themselves. If you have time, you can stay on, but if you've got to jump, I know you had 4 o'clock, you can jump. But we're just going to do a quick sort of intro of people here and go from there. So
Cool.
appreciate it,
Well,
JP.
I'm going to drop off, but I appreciate it, and I'll see everybody in 2 weeks. Thank you, guys.
All right. Thanks, JP. All right. Let's just, Alan, you want to kick it off and just give sort of a brief intro and maybe one takeaway from today's lesson with JP.
Sure. Thanks, James. So quick background on me. So I was a 20-year corporate guy in management consulting, went to A&M from the Dallas-Fort Worth area, started in multifamily investing a little over 8 years ago. In that period of time, I've been general partner in 5 deals. We sold 4 of those. And then I've been a passive investor in another 11, which we sold 1 of those, primarily in the DFW area. 1 is in Georgia. Kind of looking forward, my mission is, I've been able to retire from my corporate job. And so, now I'm trying to help, 1,000 other families, kind of do the same through real estate. And so that's really my drive behind continued use syndication and investing. And so, my key takeaway from today is, I knew that I was thinking, floating rates were interesting, but actually one of the key things that you said, James, about Freddie loans and getting the 1% prepay back, that was something new. So I hadn't thought about that. Because Freddie just, when I was the last time
on refis. Are you saying on refis? Yeah, exactly. Okay.
So I hadn't thought about that, but super cool stuff with JP.
Yeah, no, he's good. Justin? Oh, let me hit the button. Hold on. All right, you should be good now.
All right, can you hear me?
Yep, you're good.
Hey guys, Justin Bach, out of the DFW area. New into multifamily, just looking to get into it. I've been doing single family in the past. My background is treasury, finance, accounting. I guess one takeaway was really I think the underwriting and how JP was saying that the rates weren't going to change, for 5 years or so, and that's kind of an interesting take on it. And just the whole, the adjustable rates versus fixed, and how the adjustables might make more sense, with less time.
Okay, good. Nika?
Hi, I'm Nika Huffman. I'm with LaCole Investors, which is owned by a husband-wife team based in Utah. Dave and Maya have been investing in real estate for about 12 years, but on the residential side. So during this time, they've invested in 58 doors, so 15 single-family homes, 11 wholesales. They also did private lending and lent on 32 doors across 3 states. So they got the money-raising experience and risk mitigation experience from that. I've been with them for about 4 years now. So my role is to assist Maya as her right-hand gal. So I'm her assistant, her bookkeeper, her design consultant. I wear a lot of hats. We're looking to start investing in B-class apartments, emerging stable markets, cash flow, strong back-end return. We're conservative, not in a rush. We're willing to do the LP, KP to GP path to reach our investing goals. And we are bringing investing, money-raising experience, financial analysis experience to the table. And we love that we get to play grown-up Monopoly for a living.
It's great. What did you learn today with JP?
Right. I think my biggest takeaway was to not be cocky and say that we know for sure how long we're going to hold, because we're new to the game. So we might say it's going to be long-term hold, but we really should think about it twice.
Good. Donnell?
Hi, James. Thanks for putting the show together. It was great. So yeah, I set up my company to invest in multifamily, but I first started with a duplex down in New York and owned and managed that for about 18, 20 years. Then sold it and tried to do a 1031. That didn't quite work out. So I since invested in over 1,000 doors as an LP, spread throughout the country. I've got a background in construction and construction management, and I've done some multifamily renovation projects for the company I used to work for. But now I'm just focused full time on real estate and looking to get a small deal done here in the next couple of weeks, hopefully, and basically grow a portfolio and try to mirror Michael Becker over there. And also have a background in, in development or construction. So I'd like to do something like with that ultimately down the road. I have the knowledge and experience for that, and that's always kind of been an interest. But yeah, just looking to partner up with people and grow my network, and you never know what can come out of these opportunities, and meet good people that you could work with going forward.
What would you learn from today's session?
I think it was make that shift away from the fixed is better, and just consider floating even for smaller deals, and because we've kind of been preached the mantra to be safe and just stick with fixed because the outcome. But I think talking to someone like JP before you pull the trigger would certainly wouldn't hurt.
Yeah, what's actually ironic is that fixed, I would say under 7.5 million, there's actually really not that many floating rate options. It is mostly on loans above 7.5 million that the floating rate option comes in. But when you do take a fixed rate under 7.5 million, you can get what's called a step down prepayment, and that is not as onerous as yield maintenance. So, okay. Eric?
What's up?
Hey, just quick intro and what'd you learn from today's session?
Well, I'm Eric. I'm in Oklahoma City, and I'm trying to get into multifamily. I don't have a prepared saying, so I apologize for that. Today's session, I liked your spreadsheet that shows the crossover point there at the 5-year mark. Honestly, I'd love to get a copy of that, but other than that,
I'll send it to you.
Apologize. I'm doing a million things trying to keep up. I'm a little overwhelmed here in my side of the world. So
no worries. All right. We'll go over to Layla.
Hi, everybody. James, first of all, thank you so much for organizing this. I always find tremendous value in educational opportunities here. Thanks for bringing JP, and it was very interesting to hear that. My name is Layla. I'm based out of Seattle, Washington. I have a degree in finance. I have a background working as a business consultant at KPMG, where I was responsible for analyzing large amounts of financial data and providing strategic recommendations. I have been investing in real estate since 2006, staying on the single family side. The rental income from that portfolio has since replaced my W-2 job and is allowing me to pursue real estate investing full time. I'm very keen and eager to transition into the multifamily. I've always wanted to own apartments. I am currently looking for co-sponsorship teams to invest with as an LP, but my ultimate goal is to start syndicating my own deals. I am very, very interested in the Texas market. So if anybody here is looking to sponsor their deals in Texas, hit me up, please. The biggest takeaway from today was the point where JP mentioned that as long as the term is long, over a long-term time frame, it's always better to go with a floating rate. I would have not thought that at all. It was very interesting. Kind of shifted my mind and shifted my thinking.
So I guess a little clarification on that. So the first 5 years, the floating rate is cheaper. It's once it passes over. If interest, this is where it's hard, is if the floating rate keeps going up compared to when you could have fixed, then that's sort of the crossover point over 5 years where it gets a little bit, it leans more towards fixed rate. But if you're only holding for 5 years, then a lot of times the float works out better for you.
Because what I thought he was actually, this is a good point. What I thought he was saying is that when you take any given 10-year period of time, within that 10-year period of time, floating rates would have done better. Versus, I understand that the holding period is a totally different thing, right?
Right.
If my hold period is 30 years, I obviously am going to go and get myself a 30-year fixed loan. But within any 10-year period of time, for the
When you
5-year
tested
hold,
it,
you would have been, yes, that, for the 5-year
Agreed.
hold, it would have been better. So,
yeah, and I think that's because interest rates have just gone down from from every year that's been tested. But yeah, agreed. Farouk?
Hi. My background is IT. I was in IT until a couple of months ago. In terms of real estate, I have one one single family rental, and I'm passive in 6 syndications, primarily in Texas, and most of them in Dallas. My goal is to co-sponsor a deal in maybe 9 months with somebody who's more experienced than I am. And my big takeaway was that lately I've been thinking a lot about cap rates for multifamily, and I was wondering, they keep on compressing. So what's going to happen in the future? And with especially with all the perennial low interest rates. So I think I'm a little bit more comfortable now with cap rates, and that they're not going to expand, at least in the foreseeable future, maybe 3 to 5 years. So yeah, I think that's the big takeaway from me.
Okay, good. Ashley? I think I might have done.
Hey,
you're good.
I'm Ashley Garner. I live in Wilmington, North Carolina. I've never had a real job. All I know is real estate, and so I kind of grew up in the student housing business and still own houses that my dad bought some 30-some years ago and still operate those. So I'm up to like, say, roughly 100 units, but the largest complex is a 32-unit complex. And so I'm really itching to make the jump to, plus 100-unit complexes up to 200 and 300-unit complexes. So, you hear me talk about that other scenario. A lot of the stuff I'm used to doing is small local bank, recourse debt, et cetera, or with all my own or with maybe one other partner. And so I've studied as much as I can on syndications for years now, and I'm ready to kind of go to the next level. So really the deals that I'm looking at are basically North Carolina based, 100 units or above, which are going to require, a certain number of LPs and a certain knowledge of the different type, maybe agency financing, different types of financing. So this type of education is fabulous for me. Just to see that they're real people that are doing it. It's not.
There's real people. There's no doubt. Yeah, I mean, JP does a ton of transactions. That's why I wanted to have him on and just talk about it, because I think as people get more comfortable with interest rate caps, then they'll get more comfortable with floating rate loans, and then it's just one of those things. So, thanks for your question, and thanks for jumping on today. And then I think Malay, are you there?
Yeah, sorry guys, I kind of screwed up on the time. I thought it was 2:00 and I just showed up at 2, which is almost done. My name is Malay. I live in Los Angeles. I have an IT company that I run full time. And I've been primarily doing single family homes, and I invest in mortgage notes and do hard money lending. So what I have right now is time, capital, and I'm pretty good with numbers and spreadsheets. And what I'm looking for is 40 units or less for my personal portfolio, and KP opportunities and LP opportunities.
Perfect. All right. Well, that's all I got for today. We'll send out the recording, Malay, if excuse me.
Thank you, James. Thank you.
I'll send out the recording, and we will see you guys in 2 weeks. at the conference. All right, I'll see you guys.
Thank you.
Thanks, James.